That's a comprehensive exercise about all what we studied up till the topic of treasury stocks, starting from issuance of common stocks, issuance of preferred stocks, and issuance of non-monetary stocks, and also treasury stocks. That's a comprehensive exercise. In this exercise, you are given owner's equity, stockholders' equity part from the balance sheet, from a balance sheet of December 31, 2018. This is the owner's equity part of the balance sheet at the end of the year. And you are given transactions that happened during the year. You are required to journalize the transactions that happened during the year, and then you are required to prepare stockholders' equity section of the balance sheet at end of the next year, 2019. First of all, you notice that there is question mark for the issued shares, for the preferred stocks. How to calculate these issued shares? You should know that the value of preferred stocks capital, which is 2,500,000, comes by multiplying the number of shares issued by the par value. Number of shares issued is not given, but we are given the par value and we are given the total value of the preferred stock capital. So if we divide 2,500,000 divided by 50, we get the value of the issued shares of the preferred stocks, which is 50,000. And for the common stocks, this time we are not given the par value, but we are given the issued shares. The same idea. The value 5 million, the total value of the capital of the common stocks, should be the multiplication of the number of issued shares multiplied by the par value. I need to get the par value. So I divide 5 million by 200,000. I get the par value, which is 25 LE. For the shares authorized, don't be confused. We are not using the number of shares authorized to calculate the value of the capital. That's just authorized. Authorized means it's a permission to issue the shares, but they are not issued yet. To get the value of the capital, we multiply the issued shares by the par value. So if I'm not given the par value, I divide to get the par value. If I'm not given the issued shares, I divide by the par value to get the issued shares, and at the end of the slide you have the calculation shown. Then you start for the transactions. January, the first one is January 2, and then January 3, June 4, July 5, August 27. One by one we are going to show how we record these transactions inside the journal in the next slide. For January 2, the journal entry, the transaction said that issued 10,000 shares of common stocks in exchange for building valued 300,000 and inventory valued 80,000. So the common stocks were issued in exchange for building and inventory. Both building and inventory are assets. Instead of issuing the stocks for cash, these stocks were issued for building and inventory. So we debit the building, debit inventory by the value, by the market value of the building and the inventory given, and we credit the capital by the par value. As we said, always the capital is credited by the par value. You multiply the number of shares issued, which is 10,000, multiplied by the par value for the common stocks that we calculated to be 25 LE per share. So 10,000 times 25, you get the 250,000 common stock capital. The difference between the assets debit and the capital credit, this difference is additional paid in capital from common stocks. And that's issuance of common stocks for assets other than cash. We didn't collect cash for issuing the stocks. We collected other assets, building and inventory. Whatever the asset collected, it's debited by the market value. And the capital is always credited by the par value of the share multiplied by the number of shares issued. And the difference is additional paid in capital from common stocks. On January 3, it's the same idea, but instead of common stocks, it's preferred stocks. And instead of issuing the stocks for building and inventory, the stocks were issued for cash. So the debit is cash and the credit preferred stock capital. Preferred stock capital will be by the par value. How many shares were issued on January 3? He says in the exercise, issued 12,000 shares of preferred stocks for 110 cash per share. So the number of issued shares, 12,000. You multiply 12,000 by 110, you get 1,320,000 debit cash. Credit preferred stock capital by the par value. You multiply the number of issued shares, 12,000, but this time you multiply by the par value, which is 50 LE per share for the preferred stocks. So you get the 600,000. The difference between 1,320,000 minus 600,000, you get the difference, which is 720,000 additional paid in capital preferred stocks, and that's issuance of preferred stocks for cash. Then on June 4, he says, on June 4 issued 1,000 shares of common stocks for advertising company, valued 40,000. The advertising service valued 40,000. This time the stocks were issued for a service, not for assets, not for cash, but for getting a service. Instead of paying money to the advertising company in return for their advertising service, we are giving them stocks. So we are issuing stocks, and in return we are getting service. This service should be recorded as expense, and you know that all the expenses recorded in the debit side. So it's debit advertising expense, but it's not credit cash because we didn't pay cash. It's credit common stock capital because we issued stocks for this service. And whenever we record common stock capital in the credit, we need to calculate it according to the par value of the share. How many shares were issued? He said 1,000 shares of common stocks were issued for the advertising company. So you multiply 1,000 multiplied by the par value of common stocks, which we calculated as 25. So we get 25,000. The difference between the value of the advertisement 40,000 and the common stock capital 25,000, the difference is we subtract 40,000 minus 25,000, we get 15,000 additional paid in capital common stock, and that's issued common stocks for advertising service. Then in July 5, he says purchased 2,000 shares of its own common stocks. Then the company is purchasing its own common stocks. And as we explained before, that's treasury stocks. When the company purchases its own stocks from the stock exchange market, that's treasury stocks. And you'll find the explanation of treasury stocks in part 1 video. You debit treasury stocks, credit cash, according to the price paid for the shares. How many shares were purchased as treasury stocks? He says 2,000 shares of its own common stocks at 45 LE per share. يبقى multiply 2,000 multiplied by 45, you get 90,000. On August 27, sold 1,500 of its treasury. يعني from the 2,000 treasury stocks, 1,500 were reissued again in the market, and they were reissued at a price of 50 per share. So we made a gain or a profit of the difference. We purchased the share for 45, now we are selling it for 50. So difference 5 is profit. This profit is additional paid in capital treasury stocks. Debit cash, multiply the number of reissued shares, which is 1,500, multiplied by 50, the price of selling the shares, 1,500 times 50, you get the 75,000. Credit treasury stocks, the same number of shares, 1,500, that were reissued, but this time multiplied by the purchasing cost, by the purchasing price, which was 45. 1,500 times 45, you get 67,500. The difference between 75,000 and 67,500 additional paid in capital treasury stocks. That's considered profit from reissuance of treasury stocks. And we said that one of the reasons a corporation might buy its own stocks from the stock exchange market is to reissue this share at a higher price, and that's what happened here. The shares were purchased on July 5 by a price of 45, and now on August 27, not all the shares were reissued. Only 1,500 from the 2,000 shares were reissued, but this time they were reissued at a higher price of 50, so we made a gain, we made a profit. And any profit from issuance of shares is called additional paid in capital, and that's not common stocks and not preferred stocks. It's issuance of treasury stocks, so we call it additional paid in capital treasury stocks. And please don't forget this last journal entry. Some students forget this one because it's at the end of the year, sometimes not very obvious in the exercise. You are required to do it. If I just tell you that the profit at year end, I just give you the profit at the end of the year, you need to journalize closing this profit at year end to the retained earnings account. It's debit income summary, credit retained earnings on 31/12 at year end, and this journal entry is prepared to close the profit of the year in the retained earnings account. I told you before that in stock corporation, profits are not distributed to shareholders directly. Any profits realized by the corporation would be kept in retained earnings. So profits at end of the year will be added to the retained earnings account. Retained earnings account is a credit account. Whenever we put extra profits inside the retained earnings, it's credit. So we close the profit of the year by debit income summary by the profit of the year, credit retained earnings by the profit of the year. And this profit is given in your exercise to be 300,000. The last step in solving this comprehensive exercise is you are required to prepare the owner's equity at the end of year 2019. To prepare the owner's equity at year end, you just copy the given owner's equity that was given to you, and you change only the items that changed. For example, for the preferred stocks, I just copied the same items, preferred stocks, 50 LE par value, not changed. 100,000 shares authorized, it's not changed. But when we come to the shares issued, we calculated the shares issued at the very beginning in the first page of the first slide. We calculated the shares issued at 50,000. But during the exercise, he said that there is preferred stocks, extra preferred stocks were issued, 12,000 issued on January 3. If you go back to the beginning of the exercise, you'll see that there is 12,000 issued shares. That's why we added these 12,000 issued shares to the very beginning issued shares. 50,000 plus 12,000, you get 62,000. So I wrote the issued shares as 62, not 50. We calculated it as 50, but I added 12 because 12,000 shares were issued on date January 3. 12,000 shares of the preferred stocks. After you calculate the 62, you multiply the 62,000 by the par value 50 to get the value of the preferred stock capital, 3,100,000. And the same for the common stocks. I just copy common stocks, 25 par value, 400,000 shares authorized, no change. But when I come to the issued, we started to have the issued shares at the very beginning of the exercise to be 200,000. And during the transactions, we find that on January 2, 10,000 shares of common stocks were issued. And again, on January 4, issued 1,000 shares of common stocks. That's why we add the 200,000 plus 10,000 plus 1000 to get the number of shares issued up till the end of the year. The number of shares issued now is 211,000. Then you multiply 211,000 by 25, you get the value of the common stock capital, 5,275,000. For the additional paid-in capital preferred stocks, the value of additional paid-in capital preferred stocks, the beginning balance given in the first owner's equity was 900,000. You add to it the additional paid-in capital that happened during the transactions of issuance of preferred stocks, and that was on date January 3 when we issued 12,000 shares of preferred stocks. If you return back to this journal, you'll find that we had additional paid-in capital from preferred stocks by 720,000. So we add 900,000 plus 720,000, we get 1,620,000. The same for the additional paid-in capital common stocks. At the very beginning, it was 1,500,000. We add to it the additional paid-in capital that happened from common stocks that happened twice. Once on the issuance of common stocks of January 2, and the other one on June 4. You'll find we had additional paid-in capitals of 130,000 and 15,000. So we add the beginning balance, 1,500,000 plus 130,000 plus 15,000, we get the additional paid-in capital of common stocks, 1,645,000. Then the additional paid-in capital from treasury stocks, and we have 3 additional paid-in capitals. One from preferred stocks, another one from common stocks, and the third one from treasury stocks. It was when the treasury stocks were reissued at a profit of 7,500. Then we go to the retained earnings. We add the retained earnings given in the given owner's equity to the retained earnings, which is the net profit that was closed to the retained earnings account at year end. So 300,000 beginning balance plus another 300,000 income of the year. And it's just a coincidence here that it's just by chance that the two values are the same. It's not a must. In other exercises, or probably they won't be the same. That's the profit of the year, which is the 300,000 that was recorded as debit income summary credit retained earnings. That was the profit of the year. And by luck, by chance, it's the same value of the retained earnings that were already recorded from previous years in the given owner's equity. You just add the two values together to get the value of retained earnings. Then at the end, before we go to the last step, we have treasury stocks, and that's the only value that is subtracted from the owner's equity section in the balance sheet. And these treasury stocks are subtracted from the owner's equity because they are stocks that the company purchased from the market. They are not outstanding. They are not in the stock exchange market anymore. The corporation bought its own stocks. That's treasury stocks. So we have to reduce these treasury stocks from the owner's equity. How we reduce the treasury stocks from the owner's equity? We multiply the amount of treasury stocks still not reissued. The corporation bought 2,000 of its own stocks. Then the treasury stocks were 2,000. Then reissued 1,500 from these 2,000. So how much is still treasury? It's only 500 shares still remaining inside the corporation as treasury. These 500 shares multiplied by the cost of purchasing them, which is 45 LE per share. When the corporation bought treasury stocks, when the corporation bought its own stocks, the share was purchased at the price of 45. So to calculate the treasury stocks to be deducted from the owner's equity at year end, you multiply the number of shares remaining as treasury stocks not reissued by the price of purchasing them. In this exercise, it's 500 times 45, we get 22,500. This 22,500 is subtracted from the owner's equity. Then we sum all the items, and we subtract the treasury stocks then we get the total stockholders equity.